In this video, I'm going to show you a simple way to value stocks. There are 3 easy steps. I'm going to walk you through each step. There is a template in the description below. It is absolutely free to download. So let's get started. I'm going to use Facebook or Meta stock as an example. On the first step, we need to take 3 variables. First, we need to take earnings per share, trailing 12-month earnings per share. You can use services like Yahoo Finance, MSN Money, or similar services. For Facebook, it is 1377. Then we need to take future price to earnings. We can take price to earnings from the last 5 years, the average price to earnings, which is around 26. We can take the current price to earnings, which is around 17. What I'm going to do is that I'm going to take price to earnings before the recent drop in price. So it was around 23. I believe that 17 is extremely low and 26 is on the high end. So I would like to be a little bit more conservative, not take 26, but take 23. Then the most important thing is that we need to determine the growth. First way to do that is to take average growth of book value per share. According to Warren Buffett, this is a great indicator of future stock performance. So if we look at the chart of book value per share growth in the last 9 years, we can see that it was around 5 in 2012 and around 40 something at 2020. So it grew from 5 to 40 in 9 years. So that is how much doubles. For 5 to 10, from 10 to 20, from 20 to 40. So 3 doubles in 9 years. A handy way to calculate growth is to use the rule of 72. In 9 years there were 3 doubles. So we divide 9 by 3, we get 3. And using the rule of 72, we divide 72 by 3, we get average growth rate of around 24%. Another way to determine growth is to use return of invested capital, which is around 20% for Facebook. Analysts were expecting before the recent drop that the growth will be around 21%. I believe that the growth will be much slower because Facebook is a maturing company. We will use the growth of 15% for the next 10 years. Okay, in step 1, we took current earnings per share for the last 12 months. We took future price to earnings that we're going to use. And we took the growth rate. Okay, step 2. On step 2, what we're going to do is we're going to determine the future earnings per share. So how are we going to do that? We're going to take current earnings per share, which is 1377, and we're going to grow them 15% for 10 years. There is a handy formula in Excel that you can use. It's called the future value. Or you can do this, you can take 1377, multiply by 0.15 and add back 1377, you get 15. I have a description how it's done right here. And in 10 years you get 55.71 earnings per share. So in 10 years, if Facebook will grow 15%, it will have 55.71 in earnings per share. Okay, next we determine the future stock price in 10 years. We need to multiply earnings per share, future earnings per share, by price to earnings ratio. And we get 1,287. So that is the price of the stock in 10 years. Then we need to discount it back to today because the future value of money will be much lower than it is today. And how much lower is determined by the discount factor or the required rate of return. I use the required rate of return of 10%, which is around the average stock market return during the last 100 years. The same principle applies right here. We discount the future value to today. There is a handy formula in Excel called present value. You can use that, or you can use the exact same calculation but backwards. Value of Facebook stock or Meta stock will be 496. Okay, step 3. We need to adjust for debt. Facebook has $58 billion in cash and cash equivalents. You can take that also from services like Yahoo Finance, MSN Money, or other services. You can also check their latest balance sheet and take these values from there. We need to adjust also for long-term debt, which is around $13 billion. Also, we need the number of shares outstanding, which is 2.7 billion shares. To adjust for debt, we need the market cap. We get the market cap by multiplying the projected present value of Facebook stock. 496 we multiply by the number of shares outstanding, and we get the market value of 1.3 trillion. Then we need to add back cash and subtract debt. We get the enterprise value and we divide that by the number of shares outstanding. We get the fair value of Facebook stock, 513. From current price, that implies 121% upside. This type of calculation is really dependent on the input. So you have to know the company well. You have to research the company. I found it really helpful to read management discussion and analysis in recent 10K report. The risk section is really important. Also, it is really helpful to know what analysts are projecting for the growth to be in the future. You can find the template in the description below. Okay, to summarize things up. First, we need to take the earnings per share, trailing 12 month of earnings. Then we need to take the future price to earnings, and we need the growth rate. So we project earnings per share growth rate into the future. We discount it back to today using the required rate of return. We get the fair value. We adjust it for debt, net debt, and we get the fair value of the stock. You can download this template in the description below. Please subscribe using this button. Also, you can watch the next video, how to use the rule of 72, and see you in the next video.